Well, good morning, folks. Hope everybody's doing well. If you guys could help me out here, I'm going to be checking the Twitter. See if I can get a 5x5. If you guys can hear me, if the volume's okay, if you see the NASDAQ 1 minute chart that should be shown on your screen now. A bit of a delay here. Okay, thank you so much, folks. Thank you, a bunch of you. So, all right, so I appreciate your patience this morning. I was preoccupied. I was juggling a lot of things from last night. Just to bring up the speed, I did not wreck my vet. That didn't happen, thankfully. My wife's Jeep, it was being moved out of the garage to take my son Cameron to Home Depot to pick up some tools for his new job. So two people pushing the button to raise the garage door caused an issue with the Jeep being backed out and then hitting the garage bottom panel. So that kind of put me out of sorts last night. So I wasn't gonna be able to sit there and talk about the markets. I spent about half an hour trying to get it so I could close it. So if you were staying in front of my house, you would never know it, but I can see the small little separation between the panels now, and on the inside it has a little bit of a fold. So we were on the phone trying to get the folks to come out here this week to get that corrected. So nobody got hurt, thankfully. And now let's get over here to the NASDAQ first. I want to get that out of the way, and then we'll go up to a macro perspective from the dollar. We'll go through dollar today. We'll go through gold. We'll go through crude oil. We'll look at euro dollar, pound dollar, ES, NASDAQ, and Dow. And I think that will be it. As a reminder, this is my last commentary for the YouTube channel here. I'll be taking my leave here on November 11th. Will be my last video that uploads to Twitter, and I go dark. I will be in the Robbins Cup Futures Division next year. So if anybody out there wants to test themselves against the demo baller, please, pretty please, show me your edge. Fuck your awards, okay? Bring your edge out there where we can all see it. So we are looking at the NASDAQ 100 futures. December delivery. This is a 1 minute chart where everybody says it's noise. Let me get all this grandstanding out of the way here. Sorry. That's just for entertainment purposes during the actual executions. All right, so we're looking at the, oh, real quick, I'm sure you're probably freaking out. Okay, if not, you're probably ready to type it out. What about that market maker sell model and buy model lecture? I'm going to give you that tomorrow evening at 9 o'clock. Okay, so it'll be on the YouTube channel there, and I'll send the link on Twitter. If you're subscribed to my YouTube channel, I'm sure you'll get a notification for it. All right, so let's go through the business here. This is a market maker sell model. Before I get into any long-winded discussion about this particular market structure here, if you haven't already seen the video of me executing this morning using all this stuff, it's going to seem and feel just like hindsight, but I screen captured my executions and where the price was at the time at, I believe it was 953. It was just before 954. So that way you can see everything that's in this chart here is exactly what was going on. That is not market replay. Okay, there are live executions. They're not market replay. They're not fake. They're not delayed data. Okay, and everything that I'm annotating here was done real time. Before it actually reacted off of it, I was calling notifications up in annotation while price was doing it. Okay, so why am I executing on a Monday? You might be asking. Well, what's this week? What is this week? It's the first week of November, and when there is a non-farm payroll event, I will typically look to do my trades Monday Tuesday, and if I don't have anything by 11 a.m. on Wednesday of that week, then I'm not taking anything. So because I kind of like want to do today's live commentary, give you a perspective, what my thoughts are going into the end of the year, because there's a lot of things going on around the world geopolitically, a lot of saber rattling, a huge buildup in the Middle East. So something's about to pop off, and you will absolutely have that be a influence in your trading. It will greatly influence your trading, and it'll greatly influence trading into next year. So I already know I'm going to be trading in an environment that's very challenging, but I don't care. I'm going to win it. And I encourage all of you to keep tabs on it. Okay. You can watch the leaderboard over there on robinstrading.com. Look at the World Cup link, click on that, and then click on the standings link. In January, I will register my account. I will be depositing $10,000 in the futures division. I'm not going to be in the Forex division. Okay. I will be trading the bond market until I get enough of a cushion where I can start utilizing the S&P and the NASDAQ. And then where I feel it's more appropriate for me to trade, I will trade back and forth between those three markets predominantly. I will not be trading anything else. I won't be trading any metals. I won't be trading crude oil. I won't be trading any of the grain markets. None of that. Okay, it's just going to be those three markets. I talked about in my Twitter space the other day on Saturday that I'll be only taking one trade per day. I'm going to be aiming for 12.5% per week. And everything looks like it should be around 9.5 months. I'm adding a little bit of fluff in there because there may be a week or two where, because of the things that are going on around the world, I may sit still or I may draw down. So building in that, I have to have some kind of cushion time-wise. So that allows me, if I need to, next year, trade into November, a little bit deeper into December to get the number I'm wanting, then so be it. Okay, but I kind of want to try to get it done before Thanksgiving of next year, and that way, the fun starts. All right, so with all that out of the way, there is this shaded area up here. Okay, this shaded area is the daily volume imbalance for the NASDAQ. Okay, so what I was annotating on the chart was I wanted to see, first of all, it took forever for Camtasia to start. And that's not a knock against them. Sometimes it just has a really long time before it starts up. If you have Camtasia, you probably already know what I'm talking about. It takes forever sometime for it to start doing its thing before you can actually click the record button. So while I wanted to trade below here when I run on stops, I couldn't do it and have the execution like I wanted to show this morning. I had this area here. I wanted to treat that as a potential inversion fair value gap. If it would have traded back down to it and the recording would have started, I would have went long there. Same thing here. If it would have went down and touched that, then I would have used that one because this would have been a breaker. So it would have been an overlapping of this wick and the breaker, an inversion fair value gap, which would have been based on this over here. Now, in my haste, because I'm looking at this on a 1-minute chart. Okay, so a lot of you take for granted that I'm not only reading price real time, building an idea on where I want to take a trade entry, how much am I going to risk on that entry based on how much I want to build up in my position, and where is my stop loss going to be, where will be the first point where I can move the stop loss to remove risk, and also annotate where you can follow along. Everything, all that's going on at the same time, all real time. So this over here, you may look at this and say, well, I don't see how that's a fair value gap because look, he's skipping over this candle here and this one here, and he's looking at all this. So he's got two candles between. What I was doing was I was wanting you to think of this in the same way as an inversion fair value gap. Okay, but what it really is a balanced price range. I don't have the time or the benefit of time typing it out while I was thinking about how I want to work in the entries in here. You can watch the recording, you can see all that being done. But if you look at the buy side imbalance, sell side inefficiency right here, see that one big up candle right there? And then you have these here. These are two consecutive. So because that's also the same, essentially the same range, okay, I just used those price points there to annotate and have them in mind going forward. And as the market dropped down into it in here, notice it's using consequent encroachment of the range I've defined. This wasn't added after the fact. It was added as it was going to trade into it. Then, one more time into consequent encroachment, which is the midpoint of the two levels I'm highlighting, which is not support and resistance, because why wouldn't I have traded on the high over here? Because support and resistance is bullshit. So we're looking at this inefficiency here. And I liked the idea that we didn't even touch this as an inversion fair value gap over here. Okay, buy side's been taken here. It stopped here, so it respected it already, then traded through it. This candle here should have already touched it. It didn't. Did it touch it? Nope. So those are signatures for me to identify that as this is really strong. It's going to run for that daily volume imbalance, which is up here. And I will show you on the daily chart what that is to slow your roll here, okay? The inability or lack of interest for it to come back down and touch this level is very influential to me. So it gives me the confidence to know that, yeah, I can trade up here where someone else might look at that as chasing price. That's absolutely not chasing price. It's absolutely not. It's not using support and resistance. It's using levels that I've taught you very candidly on this YouTube channel and on Twitter. Midpoint of these two levels, that's consequent encroachment. I want to see this price show respect there. It does. And I'm adding to it as it's doing this. So I'm going long, I'm adding more to it while it's in here, anticipating the market to reach up into the lower area of this shaded area, which is the daily volume imbalance. Now, daily volume imbalance, those levels can be traded through just like any other time frame. But because, now think, this is the logic I was using going into this morning. If we are looking at a non-farm payroll week, the first week of November, the close of October, that means there's going to be a lot of excitement in the beginning of the week because professional traders are not trading Thursday and Friday of non-farm payroll weeks. They're not doing it, especially now because of all of the wartime stuff that's going on. All the things that's going on, it's taking a great deal of a toll on the interest people were willing to take in terms of risk. So usually I stop like the week before Thanksgiving, but I'm stopping a little early this year because of all the things that's going on. And I want to close our time together on a high note. So this is where we're at. But Mondays, generally, I'm willing to submit to not doing any real trades unless I'm inspired from somebody online, asking me to show something conceptually or answer somebody's bullshit. Then I'll do something on a Monday. But generally and predominantly, it's Mondays. I'm sitting there waiting for Monday to give me some kind of insight. I'm willing to pay that premium of letting it do whatever it wants to do on Monday and not be participating in it. So that way I'd have a better read on price for Tuesday, Wednesday, and or Thursday going into the week close. But I am always chomping at the bit to trade on a Monday during the week of non-farm payroll. That's a general rule that my students have been taught for years. For a long time, it's been publicly known that I don't generally like to trade on Mondays, but not that I can't do it. I just predominantly want to limit my trades to Mondays on non-farm payroll week because right out of the gate, there's going to be a lot of volatility on that Monday. So for the folks that are asking, why was there so much movement this morning? Look at every Monday of a non-farm payroll week. It's usually right out the gate, a lot of excitement. Because what they're trying to do is they're trying to inspire specific sentiment that will be attacked later in the week during the 8:30 news of non-farm payroll. So it's a lot of manipulation, but the cleanest price action is always going to be found on non-farm payroll weeks on Monday, Tuesday, and up to 11 a.m. on Wednesday. After that, it's a whole lot of tomfoolery going on. So if you don't know how to trade, if you don't know what you're looking for, you can be very easily chopped up. You can be led astray into thinking that you see a trade there that's not. I'm referring to things after the Wednesday 11 a.m. time. So if you haven't had a trade on by Wednesday morning's opening bell to say 10:30, and if you don't have a lot of experience, it's just don't do anything the rest of the week and just practice reading the tape and be thankful when you do it wrong that it didn't hurt you. Okay, because if I push it really hard, if I push really, really hard during the Thursday and Friday of non-farm payroll weeks, I'm more prone to have more losing trades than if I were to avoid them. Okay, so it's important that you understand that it's kryptonite for people even who know how to trade really, really well. Those conditions are very fickle, meaning that the market can go and start presenting suggestions, technically, and across all manner of trading, not just my concepts, but all of them. It'll lead one to think that it can go higher or lower, or that it might consolidate, and then it doesn't consolidate. It runs real wild one direction. And then you think, okay, well, now it's really going to run that direction or reverse. And then you get in, then it consolidates and chops you up. So that's why I teach, and I try to influence you to not want to do anything on Thursday and Friday of non-farm payroll. It's important that you understand that those days are extremely likely to hurt you. Even if you're good at trading, even if you've been doing it for a long time, you're inviting failure when it's not needed. You can simply just avoid it, okay? So anyway, because this is a balanced price range in here, we have one up candle here, and then these two consecutive are delivery to the downside. Then we have these really clean levels there. So there's buy side there and in a balanced price range. In a perfect world, it should never touch that low level. And does it? No. Does it react off of the midpoint of it between the two levels? Yes, it does. It comes down one more time and respects that midpoint. So I know at that time, when this candle closes, okay, when Steve Nielsen's crew that like to look at doji candles and things like that, there's lots of times that I have models that I go after doji candles. Okay, I haven't talked too much about that, but it'll be in one of my books. I don't know which volume it'll be, but it'll be there. And don't hang your hat on it thinking, oh, that's going to be my model because it's not been talked about. It's so many people wanting to drop everything I've already taught that works to get to the new shiny object, okay? But there has to be a logic behind why price should be moving and gravitating towards a specific level, which is, again, this daily volume imbalance up here. Then if you see these things forming, not in and of themselves, just because there's a wick or a tail on a candlestick, doesn't mean it's going to go up. Doesn't mean that at all. Many times it could, well, I mean, look at it down here. Here's support, right? Look at that, there's support. Shit the bed, didn't it? Okay, so, I mean, it's not for the simplicity of looking at candlestick patterns, because by far and large, they're nonsense, just like harmonic patterns are just nonsense, okay? And I know that upsets people when I say that stuff, but that has absolutely no bearing on what price is going to do. Zero. Has nothing to do with it. The market's going to go for liquidity above or below the marketplace on a time-based delivery. That means it's going to wait to a specific time of day where there will be a macro. That's exactly what was going on in my entry. Why'd you enter before 10 o'clock? Well, I'm not trying to trade the silver bullet if I have another model that gives me an entry. If this would have been trading to as an inversion fair value gap, guess what it would have been? Like I said earlier, I would have traded that. I would have entered on my first entry there. If it would have came back down and traded into that as a potential inversion fair value gap, like I mentioned in the beginning of this live stream, I would have used that because it was coupled with a potential bullish breaker here. My stop loss, if I would have entered on that one, it would have been just below the consequent encroachment of this candlestick's tail, like right below there. That's where it would have been. But did it give it to me? No. Does that mean, well, close the screens, don't do anything, or reverse, go short because, it didn't give me my setup, so let me get impulsive like a gambler and think, well, I'm wrong there. Let me just do the opposite. I've seen other people trading like that, and I did this as a 20-year-old in the early 90s. If I had a setup that I was looking for and it didn't work, I wanted to abandon the whole idea and try to do something entirely different that I had no understanding about. None. And I talked about that, not in the last Twitter space, but the last two prior to it, where you can really just orient yourself and leave and depart from what it is that you're trying to do and become impulsive. When motivation becomes impulsiveness, you're inviting ruin. You're inviting it. You're begging for it to happen because you can't control yourself. So you're basically going to do things that will invite you to lose money. So that way, that's your braking mechanism. The only way you stop being impulsive is when the market takes it from you and the ability to trade, it's removed. That means losing so much that you're now too afraid to take another trade. Or if you have a funded account or a funded account challenge, you blow it, hit the maximum loss. Or you completely disintegrate the entire account because your impulsiveness kicks in. Your motivation, that everything that you looked for in the chart, it doesn't manifest itself, or you're too impatient to wait for it. Then you try to predict and anticipate, yeah, if I get in now, it's just will be a better entry, because if I'm trying to buy it as a touch in the middle of this range or the top of that range, and it's down here, I might as well just go ahead and buy it. That's impulsiveness. So you're not following these PD arrays if you're doing that. You're not following order flow. You're guessing on a breakout. I am not a breakout trader. I don't teach my students to be a breakout trader. So there's logic that's being employed here. It's not randomness. It's very specific things that I'm drawing your attention to, but I don't have the benefit of a lot of time to be able to build the idea of what it is I want to trade on, because I'm pushing a button. I'm using a stop loss. I'm managing not just one entry, but I'm doing multiple entries, scaling in, and all of them have to make sense. Just not just indiscriminately buying all at the same price, like you see many times with MT4 guys. They'll show you like the gold and they're having 15 lots and they're all only off by, a tenth of a point. That's not someone trading with a model. That's just someone just pushing a lot of buttons that don't have the margin to be able to control that type of trade. When I'm showing you my executions, I'm showing you that there's logic. There is a real edge there. It's razor thin. It's highly precise. It's going to levels that are predetermined, things I've already taught you. And until it gets to those specific levels I teach, we trust that it's going to keep doing it. But if I'm trading in an environment, okay, that I'm predisposed to look for shorts more than longs, I know that the likelihood of the market is wanting to go up into that daily volume imbalance, because if we're going to go lower, I think it would have went there today, or if not today, if it would have consolidated today, then I would have been extremely bullish tomorrow morning to see this very trade here. But out the gate this morning, it ran right up there, and that's fine. Sometimes you'll anticipate certain things and you won't be able to get in on the trade. Don't get mad about it. You have to log it, record it like you saw it coming regardless, mark your charts up like you would have done if you would have been in the trade, and treat it as a learning experience. Sugarcoat it. Cheerlead yourself. Congratulate yourself for seeing it before it happened, even if you really didn't. And that's what you do with your journal. That's exactly what you do with your journal. You don't use it as a depot for depression and regret and beating yourself up. It's to constantly cheerlead yourself. Because when you go back and look at it on the weeks that you aren't doing well, it'll inspire you because you're reading it in your own words. You were there, you saw the chart. Even if it's hindsight, your subconscious retains this as pseudo experience, and it filters out all the negativity. That's exactly how you journal. If you're doing anything else but that, you're wasting time and ink. As much as it may be nice and neat, if you're not doing your journal like that, you are wasting your time with it. Chances are you're probably putting in things that are creating anchors to negativity that you might not really see it as negative as you're recording it. But unless it's so sugary sweet and at risk of a diabetic coma every time you read it, you're not doing your journal right. And for the simple-minded, okay, the people that don't really want to make an effort to learn how to do this, and they are just looking for something to troll all the time, they're not going to see the logic behind that because, well, first of all, they're not going to do this. But the folks that do it, it's a coping mechanism in the early stages of your development that you absolutely need, because you're not going to be on that high end of energy all the time. You're going to have some difficulty. You're going to miss moves. You're going to do things incorrectly. And you're going to want to find an excuse to feel good even though you didn't do the right thing then. or you want to find inspiration. And that's the trap that social media creates, where you chase these kids out here that are doing things that are outside of trading, not making money trading, but they're showing you an image. So it's important that you balance your attention in the early stages. Until you learn how to trade, you shouldn't give a shit what anybody else is doing, me included. You should keep your focus on yourself, mind your own business. And if you do that, you'll have all of the right tenets as a developing student that you're going to lean on until you acquire your own independent self decision making, where you're not being influenced by anyone else. And then once you're in that position, then if you want to waste time on social media and look at other people's stuff, or, you know, be entertained by all that stuff, okay, it's fine. But when you're not equipped, you're highly susceptible to be influenced negatively. It'll cause doubt, because especially what I teach, they're going to say that, you know, there is no algorithm, which to me is laughable. If the markets aren't booking algorithmically, why is it doing all the things I'm pointing out exactly when I'm pointing them out? It's not on retail logic. It's on the principles of how these algorithms are going to communicate with one another. Okay, the booking, the delivery algorithm, I don't control that. You'll never control it. We will never influence it with our buying and selling pressure, and that will never ever happen. These markets are predetermined. They're scripted. They're going to go up to a specific level. They're going to go down to a specific level by time. It's all time delivered. It's all scripted, just like your TV guide channel on your pay-per-view. Whenever, like I have, well, I don't have Comcast now. I was going to say Comcast, but we don't have Comcast. But if you go into your paid programming, you go to your TV guide channel. It tells you what's coming on what channel. Well, these markets run just like that. And anybody that says it's not like that is a fool, because everything I'm pointing out to you and I'm using when I'm doing these executions, and my students are using, and they're making real money, they're using the logic around that. They're not using it around anything else. Trend lines and moving averages and all that bullshit. That has nothing to do with why price is going to go up or down, how fast it's going to go, how long will it spend in that area before it starts to go the other direction. All those things are important factors, but not every single time when a market rallies up is that a market make or sell model. No. So if I know I want to be in a market and I want to be engaging with algorithmic principles, things that I've taught you, and I don't have the time and luxury to be able to be on the sell side of it as much as I would have rather been on that. I had phone calls I had to be on this morning, and people calling me back for quotes on this repair I need at my home. But I bought the buy side of the sell side model. In other words, this original consolidation in here, all this consolidation, we see it take the sell side here, and then it rallies through. Does the market come back to its original consolidation? No, because it would have done it here. It didn't do it. So is that strong or weak if we're expecting prices to be drawn up into this daily volume imbalance? It's extremely strong. So my mind immediately adopts this. Okay, as we enter this area here between these two levels, that balanced price range, if it's really going to have the influence on price that I think it should, which is don't touch the lower end down here. Don't even look at this as support now, because this used to be resistance. That's what people say. They'll say that I'm teaching you a renamed, complicated version of support and resistance. Okay, well, you never would have got an entry there. How's that work for you? Okay, it didn't work. But I'm calling out very specific protocols around inefficiencies. I'm drawing your attention to very specific levels that would be classified as liquidity. Below old lows or single low is sell side liquidity or sell stops. Above a single high or relatively equal highs or a group of highs, they're in close proximity to one another, that's buy side liquidity or buy stops. In between those two price points, there's going to be inefficiencies above market price. Anything above it would be a premium array that would be constituted as a inefficiency in price. It doesn't mean that it's only going to go up to there and not go past it to reach for buy side. Same thing between buy side and sell side on the lower end, below market price, there's going to be inefficiencies down there. You may not see a setup that uses the inefficiency and you want to trade to the liquidity. There's nothing wrong with that. Like I said, I have students that are trading in the same market, the same time frame, and they're trading two different directions, and they're profitable. And it sounds like that can't possibly be, but that's exactly what's going on, because all of them have their own unique model. They have used the things I've taught, and it kind of pisses in the cornflakes of the people that say, a good testimonial of a good teacher is every student's going to have the same entry or the same trade. And I don't believe that at all. I don't think that's viable. Now, if I was only teaching one way, okay, like if I had only taught the silver bullet at 10 o'clock till 11 o'clock in the morning, then on that ground, yes, you could say, okay, I would be classified as a good teacher and communicated effectively because my students predominantly would have the same entry, very close to the same entry and using the same target. But I've given you a litany of different ways to go in here and skin the cat, because you're all not going to see a silver bullet and see it as valuable. You're not going to understand it. You're not going to trust the pattern. You're not going to see it. So because I went through that same thing as a developing student at 20 years old, I had to have multiple ways, because every time I missed a move, every single time I missed a move, I went in there and I beat the shit out of the technicals to figure out what was happening right then and there that I didn't see. What was going on that caused me to lose real money, blow accounts, giving Lynn Waldock more money every time I open up a new account and I dusted it. I would go into those trades that I lost on. That's where you learn. You do not learn from your winning trades. You don't learn anything except for ego, pride, and greed. And those three lessons are ones that you want to avoid. All of your study needs to be on the basis of your losing trades. But you don't beat yourself up psychologically or emotionally and say, oh, I failed here. This was so horrible. I should have never done this. Be thankful that you still want to trade even though you did that, because that's a trader. A trader that takes losses, drawdown, and blows an account, but still feels like I'm going to get this. I'm going to figure this out for myself in a model that allows me to be consistently profitable. If you can maintain that in the early stages of your development, that is critical, because it's really, really easy for weak-minded individuals that don't really have their heart set on this. So they'll be more inclined to just simply take the first loss and say, yeah, this is too much for me. That's probably the best decision you've ever made then. Because if you're not equipped to be in this, come hell or high water, on the good days and the bad days, because the bad days are going to come. It's going to rain. And I'm not talking about lots of profits, like make it rain, ICT. That's not what I'm talking about. I'm talking about it's going to be a deluge where, it's bad. And you're the third monkey on the ramp and it's starting to rain. Okay. It's like do or die. So you have to absolutely know that you want to do this. And you have to dial back how much you're pressing and pushing in the beginning. Lots of leverage, lots of account size, lots of contracts, or if you're trading Forex, lots. You're trying to get the results that would hopefully inspire you. If you're not inspired by getting consistently 5 handles on paper consistently in the beginning, you will never be consistent at this. I swear to God Almighty, I'm telling you right now, anybody that goes into this trying to just make a lot of money right from the beginning, you're conditioning yourself to accept only home runs. You're treating yourself as a person that can't take a loss. So you're teaching yourself, when you do take a loss, you're going to blow your mind out. You're going to be like, oh man, you're going to try to do everything you can to fix it right away, which makes you insecure, which means you're going to have scared money, and scared money makes no money. All these factors, these are all things that are paramount in every trader's development. They have to be maintained. They have to be managed. They have to be parented. You can't let yourself just get out here and do whatever you feel like doing. That's not how you do it. You have to have rules. You have to have expectations placed on yourself that if this happens, I have to stop. If this happens, I have to turn the charts off. It doesn't mean that my model doesn't work. It just means that I'm learning, and I have to allow myself to be able to just take one adverse result in the beginning and see over time that that one adverse losing position or expectation that didn't come to fruition, tomorrow when I try to do something else using the same model, if it works, it cancels out that negative, and you don't allow yourself to make it bigger where it's hard to get out of it. It's real important to have that mindset in the beginning. But I know everybody wants to make money real quick. They want to make a payout. They want to get profitable. They want to be on leaderboards. They want to do this. They want to do that. They want to challenge people. I got it. I understand all that stuff. But how are you paying your bills? Are you just meeting it right now or barely getting it? If you want to use these markets like that, you have to treat it just like a business. And businesses are just simply not out there taking wild, crazy risks. Well, with all the silly shit that they've been trying to do recently in advertisement, I don't know. Probably not even a good analogy now, is it? Bud Light. So, oh man. But we're looking at a mindset that you have to have. Okay. And understanding that if the market is likely to go lower, and I've been calling it lower, I wanted to see it go lower. If we have these higher time frame levels like that daily volume bounce up here, okay. Now your chart is not, or your screen's not frozen. I've been jawboning over this, but this is the important stuff I wanted to get out of the way, because I know as we get into other stuff, technically, you'll be more inclined to pay attention then. So I want to do all the boring stuff that you're more likely to zone out in the beginning, because this portion of the discussion today was the most important. Everything else I want to talk about and how I use the trade, all this stuff here, and what I think the market's going to do, that's secondary. But it doesn't feel that way in the beginning. When you don't know what you're doing, you don't know what you're looking for. You want to be in the charts. Give me the gizmo. Give me the technique, the concept that's going to get me into a trade. Get me in a trade where I can only do a 1 point stop. Give me a method where I don't have to use a stop loss ICT. You know, that's the mentality that new people have coming to me. And you can see I have a stop loss in my trades. I'm managing it effectively. And every time I add a new position and pyramid that trade larger, it has to be considered. And I have to weigh out all that stuff on a 1 minute chart and still have something in here that's loosely annotated, so that way you can see, okay, I'm drawing your attention to something right now when I'm drawing this here, this fair value gap. It went down and touched it there. Watch the recording. And then this down close candle, I was looking at the midpoint of this candle right in here. What would be the middle of that down close candle? If that's a bullish order block, what's the middle called? Remember I was talking about this inefficiency, tongue twister, this inefficiency down here. The midpoint of inefficiency, or a actual gap, is consequent encroachment. It's the midpoint. The differentiation between an order block, which is a real range that has been offered liquidity, where the range has closed with a body like this right here. The midpoint of that is mean threshold. So that's the two distinguishing factors that make up the midpoint. If you grab a fib and you drop it on that specific candle right there, I'll make it a little bit bigger. That midpoint level's right here, okay? You can see how we went through it. Does the body disregard that midpoint? No. Can it cross over that? Yes. What do we call that? Mohawk. Just like when you're cutting your grass and you miss the edge and you create that little tiny little small section of, not price, but grass where you got to go back and mow over top of that. You just colored outside the lines and they got to go. Yeah, you have to, well, if you're like me, I have to immediately go fix it. Okay. But in trading, you have to allow it to be there. Just allow it. Okay. So while we have very specific levels, the bodies of the candles are telling you the narrative. So yes, it does go down below midpoint of that. Okay. And when I first started teaching my order block theory, when I talked about mean threshold, everybody would think, okay, well, I can put my stop loss right below mean threshold and it shouldn't hit my stop loss. And then because they don't know what they're doing and they're trying to write books or they're trying to make courses and mentorships all around it, and they can't trade with it, can't be showing it in their own hands working, they join the bandwagon. This stuff's made up. It's conjecture. It's not real. It's fraud. It's renamed something else, but if it was renamed, why can't someone else do it too? That's the argument I keep making as a retort to that. If this is all rebranded stuff, don't call it my stuff. Still do what I do, and they can't do it. So there's something else going on there, and I'm teaching it to you, but it's very, very dense. It's not a lot of watered down, easy 1, 2, 3 techniques. It takes a lot of a paradigm shift, really, to depart from what you think you know about price and what the markets are taught as a support and resistance, a supply and demand, a Wyckoff, a harmonic, an Elliott wave, Gann, Hurst, all these bullshit excuses for people to push a button. That's not really what's going on behind price. So what I had to create is a language for my kids to understand what's going on. And I've made that language public. So when we are anticipating specific levels to be traded to, we're not expecting and demanding that it stops on a dime right then and there. Now, can it do it? Yes. And when it does, it's a fascinating study. But it's not important. This level here, 14,422 even. See the zeros? So 22 even, and the low on this candle comes in at 19.75. So it's less than 2.5 handles. Now, if you're going to lose your mind over 2.5 handles, but you expect it to be respecting that level, you have to have a stop loss that's going to at least allow for that mohawking, that little push beyond the level of where we expect the real turning point. The real turn in price. Is it happening and justified and confirmed with the bodies of the candles here, here, and here? Absolutely. That's exactly what I was watching when I was doing the trade. I want to see, does it keep supporting that? And it does. Then it rallies through. Now, this range here, I'll just borrow this fib. And again, I'm just eyeballing it. I'm going to counsel you to do this with the actual levels that you're going to get on your daily chart, which we'll drop up into after we get through all the boring intraday noise. There's my fib level. You want to take a screenshot of that. I always toss this out there as a caveat. Interchangeably, when I want to look at the TGIF, which is the 20 to 30% of the weekly range, if I anticipate that being there or a factor for Thursday into Friday's trading, I'll change this 0.25 to simply this, okay? And then that would be the 20% or 30% levels on the weekly candlestick. But because I only concern myself with that when it's viable, it's not every single week that you're going to be able to do that. Because if the market's reaching for a target on a higher time frame, weekly or daily, it still could be closing very heavy on the lows while it's bearish and not have much of a retracement at all. But if we get to targets that are intermediate term or high time frame, then TGIF absolutely, as much as 40% can be a factor for Friday's trading or late Thursday afternoon going into Friday's trading. But TGIF is just a scenario that requires in itself also an understanding of what price has done to warrant that potential retracement. Because if the market's really, really bearish, you don't want to be trying to do what? Trade a TGIF expecting some kind of a late week rally, trying to get to 20 to 30%. Because if it's really bearish, it's not going to go to 20. It's just going to keep dropping and end up closing on a newer low or lower low, right, for the week. So it's a lot of things you have to balance. And again, that's what makes neophytes, these traders that come to me, they don't know very much about anything, and they get frustrated because it seems like there's always something new to learn. Look, there's always going to be something new to learn about you. I'm learning something new about myself all the time, but I'm not learning anything new about price. I'm not learning anything new about the markets. That shit stopped decades ago. I learn constantly how I interpret price. What am I doing that's not what I should be doing, and what are those catalysts? What are those things that's causing me to second guess my own rules because I'm trying to be, even me, impulsive? And I have to address those things. So In the beginning, you have a whole lot of that stuff going on that you don't think is an issue. You think it's the thing you're trying to learn, or the person you're learning from, because you're trying to find fault outside of yourself. And you have to be absolutely responsible as a trader. If you're not responsible with your own results, that means even if you follow someone's methodology, even if you follow someone else's trade signal, even if you piggyback 100%, that's your fault if you lose money. That is your fault. And guess what? It's all your credit when you make money. It's not that person you followed. It's not the person you learned from. You took that initiative. You took that risk. So all the credit is yours. But at the same time, all the shit on that spoon, swallow. Okay? You take that bite because you did it to yourself. And that's the part that people don't want to accept. But I constantly tell you, this is what's required as a trader. You're going to eat shit. It's just the way it is. Sometimes it just tastes better. Other days when you can pull yourself out of it. But there's going to be days, there's going to be weeks, there's going to be months, there's going to be years that you didn't do as well. And it's normal to anticipate that, allow for that in the beginning. But each year going forward, it should be better. But you shouldn't be expecting to get rich overnight. That is simply not possible for some of you that think that it's going to actually happen for you. It's not. Because you don't know what you're going to do to unwind yourself. But anyway, I tucked that little TGIF nugget in there. So this is what fib generally looks like here. So 75% and 25%. Okay, that's what's being toggled, and the halfway point, and then the high and low. That's what this is referencing. These are all standard deviations. I interchangeably work with these levels here to see if there is a confluence of other PD arrays. If I'm looking at a time frame, all that stuff will be in a book, and it's basically an amplification of what I already taught in month 5's core content. So you don't need to buy my book. Okay, I'm not trying to sell the book to make money. I could give two shits if you buy it. I don't care. Okay, I'm just putting that stuff in prints, that way everybody can know it came from me. So the idea of these quadrants here, which is not quarters theory, this level up here, all this shaded area here, quarters theory would have never even referred to that. This is where I believe that price was going to draw to, from down in here. Okay, so if this level from here all the way up, best case scenario, terminus would be the high end up here, 14,467.5. So that range is what I think that price will traverse from here to here. If I'm right, if I'm accurate, and if I'm dialed in on what I believe the algorithm is going to do, it's going to reprice to the high of that. Now, as a trader, do I demand, do I insist that it gets to that upper end, the upper echelon of the best exit? No. That's what made me frustrated, and that's what frustrates me still today with my exits, because I'm trying to crack that part of it. Because there are some times where the market will just get really, really close. And I'm going to show you that here today. But it denies me, because I wanted to put my limit order one tick above that. Let me scrub down here a little bit. That high right there, 14,476.5. I wanted my limit order to be at 76.75. I wouldn't have got a fill. It would have denied me by 2 ticks. And you've watched me do that this year. You watched me do a trade where I've taken a lion's portion of the trade off, and I had a limit order where it denied me just by 1 tick. It's going to happen to you. That's my pursuit. Like, what am I going to do when I'm no longer doing social media, no longer YouTube, no longer doing anything? I'm going to try to see if I can do a little bit more with my time, but I'm gonna spend all my days obviously doing it. But I want to try to see if I can spend a little bit more time undistracted to try to refine that. Like, I want my exits to be like my entries, which are fucking phenomenal. Okay, like they're poetic, they're scientific, they're literally based on things that no one can look at this being done. And I'm not showing you something after the fact with market replay. Okay, I'm not using market replay where there's a student of mine, and I think you're trying to sell the idea that you took a trade on Twitter, and you can clearly see that there is no time underneath the price. And it's only ticking 2 times when each candle opens up. That's market replay. Even though you're zoomed in trying to hide that part, you need to delete that tweet. Okay, that's not the type of stuff that I inspire, and I'm going to call bullshit when I see it. And my students, they should say the same thing respectfully. But that was not a trade. That was not taken by you. So don't do those types of things. But I prove with live executions, okay, this stuff's predictable. It's happening on a time-based schedule. Things that I've taught you with macros and things, there's chapters in those 3 books I'm putting out that will give you more insights. But I want you to understand this. Even though I'm going to tell you everything that I know about them, it's going to take you years working with them for you to find how it works for you and your model. They do not teach you direction. I'm going to say it again because I'm breaking hearts right now, but I want you to understand. A macro is when the algorithm will start doing a specific short order of scripts where it will do something to do something else. Okay? You still require, the burden is still in your hands to know where the market's going to go. If you don't know where it's going to go, higher or lower, to a very specific level. Now, was I right about it going into this daily volume imbalance? Absolutely. Was I precise? Fuck no, I wasn't precise because it went outside of it. That's the part that drives me crazy. The OCD in me, I need to know how I can codify that part right there. I want this cracked by my own hand. I want to be able to do that. I might not be able to do it. I'm comfortable with the idea that if I never do it and the Lord takes me home and I've never been successful doing that part of it, okay, fine. I've had a lot of fun trying to figure it out, but it's also been a great source of frustration for me because I believe if I have given myself enough time, I will figure that part out too. But I might not. And if I don't, I've done enough. And it's in the hands of my students now that they are doing phenomenal. Crazy levels of precision, crazy levels of income and profit. And it's a wide array from different walks of life all around the world. And I'm so proud of all of you. And I can't wait to see what y'all do when I'm not no longer distracting you, talking to you, giving you something else to look at. You have enough. But those macros, they're just times when the market's going to do something. Now, let me add a little bit of value to this live stream. Even though we haven't come off this chart yet, I've literally given you like 2 chapters equivalent. If it was on a book, that's what I've given you here. These are details. These are things. These are conceptual ideas, ways of interpretation that are not something that's easily communicated in a book. Whereas if I talk about it over a chart and I'm showing it to you live and you watch me trade something this morning with this very logic, it's not reaching back into hindsight in some kind of frivolous made-up conjecture. It's something that's really there, that's been taught to you already, and you see it panning out. When you watch that recording where I'm trading all of this move from here to here, and I'm highlighting this little shaded area here, my students that have been with me knew exactly what I was doing here as I was drawing that. I want to see price find somewhat support and respect of that level. If it were to break below that, then it's probably going to dig into half of this buy side and balance sell side efficiency, which would have been in many ways somewhat of a problematic situation for me. But in my mind, okay, here's a big paradigm shift. Okay, this is the part that doesn't get easily communicated in the pages of a book. It needs to be done. It needs to be shown with a real example, live, executed, where the beginning of the trade to the end. Okay. For the people that says this can be done with 20 different laptops, just try to do that. I want to see you do it. Nobody's still doing that. But this area in here, because of it's being Monday on a non-farm payroll week, it's the beginning of a new month, end of an old month. And that's a Monday that I would be trading. And the characteristic of that Monday is that it's going to be out the gate real quick trying to get somewhere. Don't take my word for what I just said. Do not do that. I want you to go back and look at the markets that you trade. Look at the Monday of non-farm payroll. So non-farm payroll weeks on Monday, Generally, there's a lot of excitement right out the gate. 9 o'clock to 9:30, there's a lot of excitement. Lots of excitement. It's designed to be that way because it gets people excited about the whole week. Because already people that are just warming up to the idea of trading, they hear about this myth, this legend of people making lots of money on non-farm payroll. It's big moves on non-farm payroll. NFP, baby, for life. And then they get out there and they wreck their ass. You know, they go out there and they do their own ass in, and they don't ever want to touch a non-farm payroll ever again. But there's always, like PT Barnum said, there's a sucker born every second. There's someone coming in here buying into that bullshit that move on 8:30 on a Friday once a month is big, easy money. And it's a big, easy hole in the head is what it is. You're playing Russian roulette, especially if you don't know what you're doing. But while everybody else, while all the retail Joes, retail Ricks, all these average folks that just simply want to get out here and just plunk their money down with no logic behind it, want to gamble, all their attention is where? Friday. NFP, not for professionals. So if Friday's really not the professional day, when is the professional day or days? Monday and Tuesday. Now, when is Wednesday a factor for smart money to be using that up until 11 o'clock in the morning? If it's been consolidated on Tuesday, or it was a limp-wristed approach to delivery on Monday, it wasn't a whole lot of excitement moving it around on Monday, then you roll into Tuesday expecting, okay, we're going to see some fireworks in the opening bell or leading into the opening bell on 9:30. Equities, Forex, everything's going to move around real nice. But if it doesn't do it on Tuesday, that means you're going to have a really fast and wild Wednesday morning session that will become choppy and uncertain right as we go into the lunch hour, New York lunch hour after 11 o'clock on Wednesday. That's not complicated, folks. That's not complicated. That's not a complication. That's not something you can't figure out how to use. It's something that's going to repeat every single month. And because I know that there's going to be a lot of excitement on Monday, I want to be in there hunting on Monday, accepting the fact that, okay, it might go stale or I might take a loss. Okay, fine. If I have it read wrong on Monday, I know that the likelihood of me getting back a loss on a Tuesday on that day is easy. So it's worth it for me to take that risk on a Monday. It's worth it for me to push in there and pyramid a position. It's worth it for me to do that because I've been doing it long enough. I've seen it. I have the data behind it. I've seen this happen for decades. For you, today, you're learning about it for the first time. And I'm reminding you, don't take my word for it. Go into your charts and study it. Collect the data yourself, because once you have it in your own hands and you see it, no one's going to tell you otherwise. No one's going to discourage you with their bullshit posts and made up bullshit. Okay, you can see it for yourself. That's important as a trader. You have to have your own evidence. You have to be able to see this in your own charts, being able to say, okay, yeah, I see this panning out, but don't be in a hurry to see that panning out in your charts. And then, okay, I've seen it one time. Now I got to go out and try to do it with a live account, or I got to try to do it with a funded account. That's the mistake that 99% of my students and everybody else's students, when they think they have been introduced to something enough, to let me go out and try it. That's not what you want to be doing. Not in these markets, you don't. You don't want to do those types of things. That is a recipe for failure. And I try to do everything I can to build you up psychologically, equip you mentally, so that way you don't fall victim to the traps of fear and greed. And even if you are profitable, don't go into the pride and ego aspects of it. Because when you start doing that, any small little loss will feel monumental, and you're going to make it bigger than even your audience would. So there's a tight wire act that you have to walk your entire career as a trader. Until you stop doing this, you're walking a tightrope, and it's so easily done that you fall off. You can fall off due to one of your strengths. And you won't even see it coming. And social media is a perfect apparatus to bring that out of all of us. All of us have that tendency. You want to defend your position. You want to belittle someone else because you're miserable. You want to compete against somebody else's methodology, their service, their way of interpretation. You just want to be significant. All those types of things. That's what social media was devised for division. So inviting that into trading is literally stupid as shit. It's dumb. But if you have a service, if you have a means of operating something, then yeah, I mean, it's a tool. But treat it as a tool, not an arena to invite toxicity, because it's easily done where it'll be distracting to you, and you'll start measuring things that are not really all that important, and it'll distract you from the things that are. So when I'm drawing out on these charts, like this fair value gap in here, in my mind, what I was interpreting was, does price want to react off of that? And if it does, I want to see how fast it can reach to the lower quadrant, which is this level here. So if we measured from the low of this blue shaded area all the way up to the top and divide that in half, that's this level here. That's consequent encroachment because it's an inefficiency on the daily chart. The lower quadrant, I want to see how fast we reach up into that. Whenever I have an inefficiency, whenever there's an imbalance at any degree of a draw, or it's ahead of a target that I'm reaching for, but I think it's ultimately going to go through some kind of let me make sure I say this correctly. Let's say that I was wanting to see 14,500, which would have been outside the scope of the price range that's being shown here. Okay, like say I believe that's what I wanted to see happen this morning. And then we also have this daily volume imbalance still. I would not be so inclined to take all my profits off in here. I would take about half, and then 80% would be up here, and then see if I can reach that target. But because this is my target, I want to see it trade up into this area here. I want to see how fast we trade up into that lower quadrant. Does it do so real quick? Well, look what it's doing here. It's hitting the low end of it here and consolidating. Now, as soon as it does that, I'm looking at my immediately, what's the closest proximity discount array? It's this order block. But we're also trading real close to what would be mean threshold of that. So I have to make an allowance for what? There's got to be 3 PD arrays. 3 PD arrays that every single time I'm looking at price as an entry, or if I'm moving my stop loss, I have to have something that's framing it where there's 3 PD arrays that would otherwise be used as an entry. If they're not respecting price, all 3 of them fail, then I'm wrong. That's where I'm placing my stop loss. Every single time I'm moving my stop in profit, never opening it up wider. When I add a pyramided entry, sometimes it'll make the stop loss move a little bit, and then I quickly adjust it to where the risk needs to be based on three specific PD arrays. So if we're looking at this down close candle here, and on this candle here, I'm watching price. While I'm not using it as an entry because we're in the target, the low end of where I was seeing it as a draw, which is the daily volume imbalance, that blue shaded area. We can't take a we can't take a pyramid there. We got to be in the mindset of taking partials. So as it's digging in to this blue shaded area, I'm measuring how much time it takes to get to the first lower quadrant. So we hit it here on the low end of the blue shaded area. We consolidated. We have 1 discount array here. How's that a discount array if we're so far away from your entry? Because this is unrealized up here, the upper part of that shaded area. Remember I was talking about this is a implied dealing range. It means it's not there yet. So if I'm buying down here and I think that the market's likely to draw all the way up here, best case scenario, which is the terminus level of 14,467.5, the upper quadrant or upper level of that blue shaded area, that's what I anticipate seeing price do. I want to see it traverse from here all the way up to here. And I'm willing to submit to the time that it takes to get there. But is it logical? Is it sound money management and trade management for me to just simply demand that's all I get out of the trade? Hell no. No, absolutely not. And especially, moreover, if you're a new student, if you're someone that's start trying to learn how to do this, you want to have logical places predetermined where you're going to take partials off and be comfortable doing that. Because taking wins with logic that repeats, number one, it doesn't feel like luck, because if you're following a process or a protocol and it's giving you the outcome that's measurable and it's gainful for you, that's not luck. You're conditioning yourself to anticipate following a procedure, a process, protocols, a model will yield you results that are favorable versus, well, last time my elbow hurt like this and it was raining, the euro went up 50 points. I could probably get 50 points today if I go in here and trade that. That's impulsive, that's stupid, and that's many times what people do. Or they sit down in front of the charts and like, oh, I got time to do something. Oh, it looks like it might go up there. Why would it go up there? I don't know. I just got a hunch. It just feels like it might go up there. And then you find yourself pushing the button, getting in those trades, and you're wondering why you're losing. Because you're not following any logic. You're not using any basis at all upon which the market itself will refer to as a reason or a catalyst for price to go higher. That's what I'm teaching you. I'm teaching you technical science. This shit does not just happen because I'm pushing a button. I'm pushing the button because I know it's going to happen. That's the paradigm shift that has to take place. And I know there's a lot of people out there, some goober out there, there's no edge. There's no edge. Motherfucker, I'm out here with twin katanas, swinging them every fucking week. Laser precision. There's no more finer edge than what I'm showing. Okay? There's no finer edge than this. This fucking glass trophy, shove them up your fucking ass. Go in that Robbins Cup, and we're going to see who's got an edge. Okay? So many people in this industry have believed that they have something of significance because there's so many glad handing. Oh, well, you have a title here, you have a title. Fuck your titles. Fuck all that bullshit. What are you able to do? Because doing a lot in this industry is like 20 to 30% a year. This was 18 fucking percent just in this trade. Just in this fucking trade. And it was done poetically with such a degree of precision using the very things that I'm teaching and have already taught. These are things that my charter members, they know these things. You know them because I've made that content public on the YouTube channel. And none of it hinges on anything else you've ever seen. Just because an area is shaded doesn't mean that's a supply and demand zone. Sam Seiden never taught this kind of stuff. Chris Laurie didn't teach this kind of stuff. Okay? I'm just telling you, that's just the way it is. But you're not going to learn it real fast either. And I never said you would. I said I would make it easy. I would make it easy for you to go through the process, which is me encouraging you constantly, giving you examples of it, me using it, giving you something to study with. Because if I can't do it, then it doesn't exist. If there's no algorithm, the things I've talked about, the things I've teach, and the things that I drone on about, like I'm doing here and on Twitter Spaces, that wouldn't hold any, and it wouldn't hold any water. And my students wouldn't be able to find any efficacy in using it, but yet they are. So if there's an element of time that's being a large influencing factor in when price is going to do something, okay, it's important for you to understand where they are. Not trade on the basis of patterns for pattern's sake. That's not the importance here. The importance is knowing what the market is drawing towards. Why should it have gone up into this blue shaded area at all today? Because we're extremely oversold and we don't need an indicator to tell us that on the daily chart. It's been pressed down a lot all last week and for a month or so. It's gone down. We were looking for this very event to take place. We're not surprised by it. We didn't wake up last week and say, man, look at this. Where'd this come from, right? We outlined quarterly shifts that takes what? Months to develop and deliver. Now, you might not have the ability to hold on to those types of trades, but even if you don't, you have to understand the benefit of knowing what it's likely to do on those higher time frame weekly and daily charts. It's important to know that because it'll help you determine where the emphasis should be placed on your draw on liquidity. In other words, the trades that you're trying to frame, if they're inside of that logic, whatever you think is going to happen on that weekly and daily chart, I guess classically defined, we can call it a top-down perspective. Buying in itself, just because you want to call it or label it a top-down analysis, you still have to know where are you getting in. Because we can sit on the sidelines and bark and say, oh, this is everything else. This is just top-down analysis. Everybody does that. I don't see everybody else doing this. I don't see it. I see my students doing it. But outside of our community, I don't see anybody doing this. I'm not saying they can't have winning trades. That's not what I said here. But to the degree of precision, why and when it's going to move like it's going and where it's going to, nobody else is doing that. Nobody else is doing that. Because there's no rhyme or reason outside of what I've taught that causes price to go up or down at the time at which we anticipate and expect it. That's a macro. A macro are small little intervals in time. Okay, they're always 20 minutes. There's a 20-minute cycle that at specific times of the day, if this macro is going to be employed, and there are times when it won't, that's where I'll get it wrong. I may have to sit in more drawdown than I'm willing to and measure and weather a drawdown in a trade to see if it wants to move once it gets to the next level of which time is going to tell me it's going to move. Or it hits my stop loss. Or it moves enough for me to say, okay, I'm going to take half the trade off. Or close the trade. Now, just that statement alone takes 5 fucking chapters just to scratch the surface up because you want someone to sit down here and say, give me a 5-minute trainer. How the fuck can anybody give you all the reasons why any one of those things could be considered for your trade that you're in right now? It takes a lot of other supported topics and experience having seen price action. But some of you are so new and entitlement minded, you think that you are owed everything the first single time you sit down with somebody, not just me, anyone. Well, give it to me right now, and I've already waited too long. When I've already told you this is going to take a lot of time. It's going to take a lot of effort, energy, and it's going to be met with a lot of adversities that most people aren't equipped to endure. But if you're willing to endure it and study and stick with it, you will be able to see price in a way that nobody else does. They're still trying to clamor and make excuses about there is no algorithm. And the people, these old hats, they know because they were in the floors. They were on the floor in the pits. And they know there's something different right now. Something different going on. Yeah. It's 100% electronically controlled. Where it was manually controlled before, still, now it's 100% AI. It's been AI before AI became a talking term. You can't argue with this, folks. You can deny it. There's nothing wrong with denying it. And, you can claim that it isn't there as much as you want it, but it doesn't change the fact that it is. Just the separation between these two candlesticks here. This is a volume imbalance. Volume imbalance is the same thing that's shaded here in the blue area. That's on a daily chart. It's a larger range. Okay. Now, because this is the part where you write shit down, folks, but because you want to listen, or you're working, or you're driving, or you're doing something else, or you're falling asleep, you're not going to write this stuff down. And it's going to go right over your head. And other people are going to learn how to do this, but you were here listening to it too. But you won't get it. The higher time frame, the larger the imbalances, or like in this case, the volume imbalance, it's a larger range. The smaller the time frame, the smaller the imbalance. So if we're going to be using a higher time frame, for instance, like a 4-hour daily or weekly, I'm absolutely interested in the quadrants. Anything less than that, I'm only interested in the low, the high, and the consequent encroachment midpoint level. Because this is a daily volume imbalance, I want to know where that first quadrant is and how fast does it reach up in there. It does it real quick and energetically. And what is it telling me? What is it telling you? Where did it close on that candle? When it hit it, what did it tell you? Did it close below it? Nope. Closed above it. That is a signature. Okay? That's a signature. Listen, I'm going to tell you something right now, and I know some of you don't want to believe this. You think it's all hokey bullshit, okay? Some Tom Clancy bullshit, okay? But it's not. It's really real. The algorithm that delivers price, there is a class of trader that is actively among all of us. They're not out here trying to draw attention to themselves. They are cannibalizing everything. Okay. They have created high frequency trading algorithms to do a lot of what they do. And when these things like this happen, it tells their algorithm, like I have Enigma. Enigma is not what books price. Enigma, it handshakes with the algorithm that delivers price. And what does that mean? My algorithm would see this close above that upper quadrant and say, okay, now I can take a long if it trades down into a discount array. So it's going to have to go back through. Where are we at right now? We're here. So go back down. We have consequent correction of this wick here. Opening of this order block, mean threshold. So is it permissible to see price wick through mean threshold here, but not close? Yes. Does it do that? Yes. Does it close below mean threshold? No. Does it close below the volume imbalance here? No. So where's price going to go? Higher. Every other person that is deemed smart money, central bank level, cannibalizing traders, okay, they're out there doing these things, high frequency all day long. They're entering on this because they see this was the qualifier to say, okay, we're going to go higher. Now, if it would have closed below this quadrant level there, they're not going to take that trade. They're not going to be in it. Even if it does go up a little bit higher here, it might go there and then roll right back out of it. That's why these things are important. That's why I'm teaching it to you. Those are the little telltale signs that I call a signature that we're looking for in price. If it's not there, I'm not taking the trade. If it's not there, I'm not holding the trade. If it's not there, I'm not going to reach for another objective to take a partial. Where is the next level in quadrant? It's the consequent encroachment. It reaches energetically right here. Where's the close on it? Above it. What's that telling you? It's going to keep fucking going up. Okay? It's going to keep going up. That's logic, folks. That's how it's done. That's real fucking order flow. Save your bullshit, level 2 bullshit, okay? These ladders, these DOMs, that's all horse shit. That is all gimmick. It's fucking gimmick. Everything is measured and everything is time delivered. Everything is. You honestly fucking think that these people are going to let their entire ability to get rich every single fucking day and control every step of every financial institution, every country, all of it's at the risk of all of us as speculators that if we all collectively got together and we short sell it, we could send this shit into oblivion, right? That's what you fucking believe? Just like the people on Reddit, just like they believe that. How did that work for them? How did that work? AMC, where the fuck's that stock at? You're not going to beat them. It's their fucking casino. So you might as well warm up to the idea it's beneficial that it's rigged. It's a good thing that it's rigged. I wouldn't fucking trade in it if it wasn't rigged. How are you going to be able to know for certain what you're doing has any edge? You don't. You're fucking gambling if it's like that. It's gambling if you're doing it that way. Upper quadrant. Does it close above it? Oh, hell yeah. So that means it's going to reach for what? The upper end of the inefficiency, that blue shaded area. And bang, 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 up here. See that? So let's roll this back a little bit here, give you some more detail, and we'll find our way off of the NASDAQ. All right, if you look at this low here, this is just swing projections. Excuse me. All right. So if you're looking at just these 2 points here, this low and this high, if price were to break through that, we can anticipate all of these levels here. Now, I use these levels like this one here. It's real hard to see. I apologize. But if you look real close, you'll see that that is a quadrant. I'm not a quadrant. It's a standard deviation. And it is close to that one right there. That's what? It's the first quadrant of that daily volume imbalance. And that's why we see it hit there and it consolidates. Then, reaching up into -3 standard deviation, we get 1, 2, 3, 4 times outside of these candlesticks. It's really trying to get to that level. So when I'm teaching you in core content month 5, where I'm teaching standard deviations, I'm looking for these kind of agreements, these confluences of where certain PD arrays and those levels within a PD array that I are teaching you are influential in terms of price, where there's a collection of them, where they're coming together, coming together in a convergence. That's more impactful than some bullshit trend line, okay, or some kind of indicator. Because all those things that you're adding to your chart with lipstick and stuff, that's a religion. You're believing something for the sake of believing it, versus these are factors that the market's going to reach for on the basis of inefficiency. So if we know, and I'll put it like this, if we know that it's likely to draw up into this blue shaded area, what did we talk about down here? They're mohawks, right? I mean, you can color outside the line. It can go to where you think it's going to go, but just go past it just a little bit, because everything has to allow for what? The spread. So the algorithms that these high frequency trading algorithms are handshaking with the algorithm that books and delivers price. Make it short and sweet. The algorithm that causes the high and low of the form, that's predetermined before anything happens in the day. The high and low is already predetermined. It's already predetermined. Now, I know some of you don't want to believe that. Okay, I'll let you believe whatever you believe. I gotta get a power cord here. Give me a second, 1 second. This is a bathroom break, intermission. Breaking hearts. Breaking hearts. This guy's ruining my mentorships. Fuck your mentorships. All right, so, okay, we're looking at the aspects of mohawks, okay? Trading outside the levels, coloring outside the lines, if you will. That's what I refer to as something that's permissible. That means we don't look at it as less than efficient. We don't look at it as less than precision. We don't look at it as noise. We anticipate very specific things to see price draw to, okay? If this inefficiency here that's shaded in blue is on the daily chart, that means that we're going to be now considering its quadrants because it's large enough to be referring to it. Contrast that with this down here. Okay, it's so small, it's not essential. There's not much of a difference between the low, the high, and let me scrunch it back up so you can see again what I'm referring to. It's the balanced price range over here that's going to act just like an inversion fair value gap. Trades down into what? If it's an inversion fair value gap, we want to see it respect consequent encroachment, which is midpoint. Can it trade to the lower end? Yes. But it's not likely to do that if it's coupled with a balanced price range where price goes up and down. So it's traversed between these two price points of this candle's body and this candle's body and that one. It's offered buy side and sell side. So it's efficiently delivered and booked price between those two price levels, which is what I'm highlighting here. But when price was trading down here, I was telling you at the time of me doing the execution, internalize it the same way I've taught you a inversion fair value gap, which would be treated as support. Now, do we simply just trade it on the high of it? You can, plus a tick or so. Sure, you can. But your stop loss has to be at least considering the fact that it can do this little mohawk thing. It can do that right to that low if it's an inversion fair value gap. So in other words, it can create just one tick or two below that. But it's not likely, highly probable that it won't do that because it's coupled to a balanced price range where price has gone up and down within those very specific price points. That's why consequent encroachment stops it here and stops it here. The bodies confirm while you're watching price because it doesn't close below the consequent encroachment. So if we're anticipating and allowing for a mohawk, something that's just outside the lines of what we're anticipating and seeing as impactful, noteworthy in the trade, in the tape reading, in the price delivery, we're not reducing its level of precision. When it does this, we are already expecting it. That's all that this is right here. This right here on a 1 minute chart, you can see the bodies of the candles here. But if you go up to like a 5 minute chart, that's just going to be a wick. Well, let's just do it. See how it's a wick? So this is a mohawk inside of the daily volume imbalance. So it's not a matter of, oh, it's the algorithm's changing. Look, it's not respecting. It's doing everything that it would normally do. But your trades and how you, and if you automate what you're trying to learn from me, and you create your own algorithm, and you can do that, those things will handshake with the algorithm that delivers price. Okay, the algorithm is going to determine the high and low of the day before we start trading in midnight, New York local time. At that moment, right then and there, the high and low is already determined. It's already determined. I don't give a fuck. Your heroes, everybody out there, whatever ICT says, it doesn't fucking matter. The high and low is already predetermined. What I've given you is resources to lean on to help you determine what that is. As close as I can, that's what I've done. Now, if you know that it's a high probability that's going to create a high or low of the day based on something like this daily volume imbalance. Okay, in other words, we're bearish. We've been bearish on the indices. If we think that it's going to go up to go down, and we can run numbers on the range at midnight, then we run the range again at 8:30, run the range again at 9:30. Where's the highest high and the lowest low? And what does it still have in play for a reach or draw on liquidity? That daily volume imbalance. When we go to a daily chart, and I know, look at how much I've taught just here, and we haven't, just by 1 minute, not even a minute really on the 5 minute chart, everything I've talked about here just on this 1 minute chart. It's deep, folks. It's fucking PhD level shit. Like, I can't take 30 years and compress it into a 5 minute trainer because you're fucking lazy. I can't do that. I can't do it. No one can. Now, I can talk and introduce things conceptually, and you're going to have 1,000 different questions. But when I'm teaching, and I already know what questions you're going to ask. As soon as I'm saying something, I already know what questions are rising up in your head. But you have to lean on other supporting topics and things I've already made available on this YouTube channel for free. You dig into it. But you don't need to have this level of, well, madness. Okay, I need to know why it does it, not just simply, is it likely to do it? No, I need to know why it will do it. I need to know when it will do it. I need to know when it won't do it. That's the thing that's been a driving passion for me. So we see this area here as a small little deviation outside of what we were expecting, which is that blue shaded area. Okay, so now with these quadrants out, we'll take that out of there. I'll take this lipstick off. If we were looking at it from the scope of the bodies, right there, because I teach this also in the core content, where price should be reaching for a range that's based on both wicks and in the bodies. Okay, and since we're looking at the 1 minute chart and we're trying to execute on the 1 minute chart, this is where you would have that there. It's calling for 71. So 71, it still has a deviation outside of that. Does that change or indicate that this algorithm is somehow now changing or morphing or no longer works? No. You have to come to the conclusion that your exits don't require perfection. Your entries don't even require perfection. If you trade with a measure of leverage that is reasonable, it's sober, okay? In other words, you're not trying to do 15 fucking contracts because Top Step said you can do 15 contracts. That's gambling. That's absolutely gambling. That's absolutely making sure that you won't be successful. Nobody should be impressed when someone's trading with 15 contracts and they get big wins, because that is a lottery win. There's people winning the lottery all the time. But how many resets are they going to do? You've already seen, I've been very candid. My son has done multiple times doing that. And he's done it very quick. Every single time he tried to do the 15 contracts. He tried to go back and do it again, and same thing happened. So the moral of the story is what? Trade with the least. Give yourself the ability to stay in a trade without having all the, I guess, the fear, anxiety. What if I do it wrong? If you're trading with the smallest degree of leverage, it shouldn't matter. It won't matter, really. But see, you're trying to press into every transaction and every moment you're in front of these charts that it's making you lots of money. And that's the fool's way of learning how to do this. Nobody gets to the finish line fast, profitable, doing it that way. Nobody has ever done it that way and has found consistently profitable and hugely profitable. No one has ever done that. Nobody has ever done that. You're not going to be the person that does it. And you're going to prolong this learning curve for yourself, thinking that you're going to speed through it because you're doing it that way. I'll learn how to trade by trading with real money. I can only learn if I do it with real money. I won't appreciate the lessons. No, you're going to get scar tissue. You're going to be scared because you've taken real losses while you shouldn't have done anything. You don't know shit about trading. You don't know anything about yourself as a trader. You don't know what you're going to do to wreck yourself, but you're going to learn those lessons painfully and attach that to money. And your subconscious is going to look at these charts and say, yeah, it might do that, but the last time I touched that, I got a lot of money taken out of my ass, and I don't want to do that again. So what did you learn? You learned to be scared. You learned to be afraid to take a trade. You learned to be fearful instead of following a model. Well fucking done. You didn't listen. But some of you think that you're the exception. You're not going to be the exception. You're going to be just like everyone else as a statistic. You're doing all the wrong things, thinking that you're going to be the one that can skate through it with no problem. And it's not going to work for you like that. All right, and this is your fulcrum point right there. So from the low to that swing high there, if it breaks above that, you can look for objectives here. And this one just falls short of that. So you never got that. And the last one on the bodies. Just falls short of that one there. Okay, so I wanted to use this one here, and I wanted to use a limit order that would have never been filled based on this logic, because I was going to exit just below that by a little bit, and it never would have filled it. I wanted to have 0.75 and the high was 50. So yeah, 14,476 and a half. And I wanted to be out at 14,476.75. And had I done that, you would have seen me not get the exit, and I would have ended up closing it down here or stopped out, and missed the actual high point. But I was exiting right at the high end, above the upper quadrant, but before getting to that high of the blue shaded area. So that's how and why I managed it the way I did, and where my partials were and whatnot. But all these things in here, you're not going to find this stuff here on support and resistance. What I just outlined, all this stuff, that's not support and resistance. That's not Gann. That's not Wyckoff. That's not supply and demand. It's not anything but mine. It's a language that I created because I know things that you're not going to find in books, and no one else is going to step out here and teach you it. If they knew it, they'd be doing it. If they could come close to it, they'd be showing you. So you either make the decision, either you subscribe to the idea that these markets are algorithmic, and if you do, use the things that I'm teaching you, and it'll be easier for you to trust the time that it takes for you to learn how to do it. If you don't want to believe there's an algorithm, you're going to constantly wrestle internally that I'm wasting my time because you don't believe there's an algorithm. You think this is a free market. It's not. It's a rigged market. And you should not be upset about it. You should not be mad about it, because common sense should tell you that countries and central banks would not allow outside influences to muscle and strong arm it into oblivion. Because if this really was a free market, you don't think that the actors around the world that don't like our U.S. markets wouldn't sink it any given day? You don't ask the right question. You don't ask the right questions. It's like you drink the same Kool-Aid. In this industry, and the people that are in it with their little titles and bullshit, they learn from this person. This person tells me the market does this, but these people aren't going to tell you with a 1 minute fucking chart, with a 15-second chart, this is where it's going to turn on a fucking dime. It's going to go somewhere else. If it wasn't rigged, if it wasn't algorithmic, there's no fucking way anybody could do that. Let alone me, little demo baller from Middle River, Maryland. Oh, I'm having so much fun. Anyway, let's spread this out a little bit more and give you some detail about market maker sell models and buy models. So if we're anticipating the market is likely to continue going lower, because longer term and higher time frame, we've been saying that we're trying not to pick a bottom. Okay, so you have to open yourself up to the likelihood that every new opportunity in the marketplace intraday should be more heavily weighted on creating short opportunities. It doesn't matter that I did all this buying in here and it looked really pretty and it was nice, and some of you did the same stuff that I did today, which is great. That's a testimony that you have learned a language that works, and you are able to find a model in your own hands. Do it without me, because I didn't make it public to you. I didn't tell you what I wanted to do today. I executed on the things I teach you, though. But if you are looking for shorts, you would anticipate the market drawing up into this area here. And I guess it's fine time to show you what this is. I've been talking about this one time frame. Let's go up to a daily chart. I guess this is a good time to invite you to, if you are learning today, this is one of those times where you can click that little thumbs up button. It doesn't charge you anything. Your PayPal won't have any transactions against it. Your credit card won't be swiped. I promise you, it will be free. But it's an encouragement that you found some insightful information today, because I'm literally giving you stuff that charter members are learning with you. You're learning insights and things that I'm brushing over that are going to be topics in books that you really don't need these levels of understanding. You don't need it, because what I've already simplified on my YouTube channel with the models I've given, it's straightforward, simple things. You just have to understand how to read the tape, and that's being in front of the chart and seeing the things I've already given you as rules, how they repeat all the time. They repeat all the time. It's every week, every day, and it won't stop. So this candlestick's close here. And then the very next candlestick, and again, this is daily chart. So every candlestick here is a daily representation of the highest high and the lowest low, where it started trading, where it stopped trading. Okay. I'll add this because this is my last video. This set button here, I use this interchangeably. So if I click this, it changes sometimes a little bit. You can see, watch this candlestick up here. Okay, watch the close of it. It'll change. See how it's a little bit higher there, it's lower there. I use both readings. I use both readings because I want to have those levels in mind, because traders are going to have it toggled on sometimes, and sometimes they're not going to have it toggled on. So I want to know what retail is doing, and a lot of retail uses TradingView. And it's not a knock against TradingView. I love this resource. If I didn't like it, I wouldn't use it. Okay, should you use it for your own trading? That's something for you to determine. I get nothing from them. They've asked me to have an arrangement where they give me something for telling you to use it. I said no, and that's 100% honesty. I have no affiliation with no one. If I tell you something, I like it, it's the truth. If I tell you it's bullshit, it's the truth. Okay? No one's influencing my opinion about anything. No one's going to get me to say something nice about something that isn't good. So it is what it is here. I don't sugarcoat anything. But just so you know that this is the settings I have here. So is it set on the blue? No, it's set to off. See that? So I used these two reference points right there. That's what that volume imbalance is. So that was in my chart this morning while I was taking the trade live. You watch me execute, you watch me manage the trade, and it was based on this logic that we were down here, and it's going to do what? Trade up here. But ICT, you're teaching support and resistance, buddy. You're just making it complicated. Why didn't it go up to that low? It broke below this low right here. Why didn't it go up there? Because it doesn't fucking need to go up there. It doesn't need to go there. It's not going to go there. Where's it going to go? Where I'm telling you it's going to go. The algorithm that delivers and books price, that's a predetermined, it's a scheduled event. It's going to happen whether you fucking own it or not, whether you buy it or short it. It doesn't matter how many people are buying it. It doesn't matter what the volume level is. It does not fucking matter. None of that shit matters. It's going to go up into this level here. Why does it need to go here? Why does it need to do that very thing right there, going up to that point? What's missing? Volume. Why would we say that? Because look, this candlestick's low right here. This candlestick's low. Well, I'll just borrow this. It went up to that level there. So if it's support resistance, why not just use this daily low? Because it's not fucking support resistance. Why didn't it stop at this previous daily high? Because it's not fucking support and resistance. So what am I looking at? I'm looking at the difference between these two candlesticks' bodies. Even though they are joining and slightly overlapping with these two wicks here, this candlestick's wick and this candlestick's tail. Let me elongate a little bit so you can see it. So this one has a little bit of a tail underneath it, and this one has a little bit of a wick on the upside. Okay, you see that? The fact that it doesn't have a body overlapping the close to open of these two candlesticks, the algorithm will reprice to that. Do not take my fucking word for it. Go back and look at your charts. It's happening all the time on every single time frame, even on 5-second charts. That they're going to say is noise. It's not noise. It's not fucking noise, okay? The systems that run these booking engines that create price fluctuations that you think are random acts of buying and selling pressure, they're starting from a lower time frame, working their way up to a higher time frame. And then they cycle down from that higher time frame back down to the lower time frame. They're doing this all day long, all night long. That's what's going on. It's a price delivery continuum that starts from the lower time frames, moves up to the higher time frames, and once it fulfills the higher time frame, then it starts dropping back down into lower time frames. And it's not just time frames that you see me point to, and I'm not telling you what they are. So don't fucking ask me. I'm not going to do it. I don't give a fuck who asks me. You're never going to get it out of me, period. But I had to create a language that you guys can use because it's extremely much more complicated than I'm showing you here. And if you understood how much of a complicated subject matter this is, it's a miracle that I got this far with it. Like, for you to be able to see this is a success for me. I can see how you all have learned from it. And that's what I needed. I needed to see that if I could create that. So I know I've been over the target, and now there's nothing anybody can do to punish me because I didn't teach you exactly what I know that I can't teach you. But it's close enough that you guys are now murdering these fucking markets, and they can't fucking stop you. They can't tell you you can't come to the table. There's too many of you. There's too many of you. So fuck you. How's that work for you? So there is a volume imbalance in here because the bodies are not overlapping that gap between the two bodies here. So the close of this candle, the close of this candle and the open of that candle, it's lacking a candlestick body. You see that? So what does that mean? It means that that range that I'm highlighting here can be revisited. Now, Chris Laurie and anyone else that talks about those inefficiencies, those imbalances, those liquidity voids, that's not a liquidity void. This is an inefficiency. Okay, a liquidity void is an actual gap between one period to another, where there is no wick, there is no body. That is a liquidity void. It's void of all liquidity. This is not a liquidity void. There was buying and selling in between the close and the low. There was buying and selling between the open and the high. Both of those two price points or two time intervals in the individual daily candlesticks, they both intersected and overlapped a little bit there. So that is not a void. It's not a void. It's inefficient. So what is it needing here? What does it need? And if we open down here on a Monday of non-farm payroll week in a market that's highly destabilized because of all the geopolitical things and war savoring going on, there's no economic reason to own stocks. They're absolutely inflated. There's no fundamental reason to be long stocks. And I was laughed at a month and a half ago when I said it was going to go lower. And people are blocking and trolling me from silence now. They found out that we were right. It did what we said it was going to do. Because what I'm teaching you is the market. It is the market. It's not patterns. It's not theory. It's the market. It's what the market's going to do. So if it's an inefficiency like this where there's no bodies, we can anticipate the market wanting to reprice up into that. Even if it goes higher, it doesn't matter. That gives you an opportunity to do what? Sell short here and reach for the liquidity that was used prior to the run up. But if it's bearish, this is a wonderful area to see price draw up into, thinking what? We created a low, we created a bottom, because the stock market by itself is predisposed to go where? Up. It's ingrained in everybody's mind to buy stock. Buy stock. Buy the stock market. Be a holder. So that premise is constantly primed in the thought processes of traders. I want to buy stock. I want to buy call options. I want to buy something. So if we open up here, it gives you the inclination that, well, hey, look, we gapped up higher from where we closed on Friday. So that it gapped up. We traded down a little bit. Okay, wonderful. And then sent it up to a level that is predetermined, that these exist. I taught it to you. It's there. That blue shaded area was in my chart from the time my trade opened until I managed the close of it. That's not random. But the logic was it's going to offer a revisiting of this area because there's no body. Now, there still isn't a body. It's just a wick. Today's wick went there today. And volume imbalances, we know that it's likely to go through them. That's one of the PD arrays that you have to have a lot of flexibility. And they can also be used multiple times until, this is for your notes for the folks that aren't writing anything down, once there's a body laid over top of the close, the open here, whether it be an up close or a down close, once the body is laid across that, I'm not going to refer back to that volume imbalance ever again. That's not to say that you can't use it again. I'm saying that I won't use it. That means it's expired at that point. But it will not expire at all until there's a body laid across this range. And this is just a wick, okay? So there's logic there. There's sound logic being employed there. It's not just some conjecture. It's something that I've taught my students. It's something I use in trade examples that I'm showing you. I use it in my analysis when I'm talking to you on these higher time frame charts. You've seen me doing it now for a year and a half publicly now. What have you seen me get wrong? Short list. It's a very short list, isn't it? So I'm counseling you to don't just take my word for it. Go back and look at the things I've taught you and see if you see them in the chart. And you're going to be convinced rather quickly that it's there. So then you have to sit in front of the charts and learn how to see them happening real time. In the beginning, you're not going to know what it looks like before it happens. But then over time, you'll start recognizing things. Oh, I've seen this before. This is like that thing he talked about. And then boom, there it is. Every one of my students have the same epiphany. Not at the same time, not the same length of time, but they all have the same thing. Wow, it happened when I wasn't really expecting it. It just happened, and I can see it now. But once you understand it and you see it, you can't unsee it, but you can't rush it either. And that's the part I wish I was better at as a teacher to help you with that. But in my honesty, I don't think there's a way to do it because all of us bring our own baggage to it. The things that we wrestle with the most. So that's the imbalance, the volume imbalance on the daily chart. And we've dropped down to a 4-hour chart now. You see how even on the 4-hour chart we have that. But look, was that a candlestick body? Nope. But on the 4-hour, look what we have here. Did it close over top of that with a body? Nope. It still had this portion here. So this is still in play. It can be utilized again. It's not expired. 60-minute chart. Same thing. Did the body close it in on any one of these candlesticks? Nope. So that does what for me? It tells me that this needs to stay on my chart. If we go into a time frame, hourly, 4-hour, or daily, and a body is laid over top of it, why am I using these time frames? Shit, he just read my mind. Why not any other time frame lower than that? Because 1 hour, 4-hour, and daily are my swing trading time frames, and I don't want to use a daily volume imbalance and cancel it with something less than an hourly chart. Look at my core content lessons where I talk about how using one time frame with another time frame to qualify another trade. I talk about that in greater detail. I'm not going to waste my time with it here because I've already done it. A long-winded discussion there with the real examples and how to think about moving one time frame to the next if I'm swing trading, short-term trading, or day trading. All right, so let's look at the 15-minute time frame just for the sake of market structure. And even on the 15-minute time frame, it didn't quite close it in with the body. So you can see how it's done. Everything I'm teaching you how to use a volume imbalance, all those signatures are still here. Okay. So in short, what that means is it can still run back up here and touch the low end or consequent encouragement of it and not get up here and still go lower. Or it can go all the way up and close it in and go lower. That's one of the things that we could probably see because it's not for a week. So to me, like I'm done. Like I'm content. $17,000, one clip on a Monday of non-farm payroll, delivered beautifully with precision. I'm satisfied. Like I'm done. I'm good. I don't need to do anything else in the PM session today. I don't need to do anything on Tuesday. I don't need to trade on Wednesday to squeeze something else out. And I certainly don't need to do anything on Thursday and Friday non-farm payroll. But contrast that with every other retail trader out there. They're anticipating a lot of movement on Friday. So they have their hopes set up for a lot of action on Friday. And that's something that I tried to steer all of my students away from because you shouldn't be excited about taking the trade. It should be boring. You should be bored out of your mind that I'm going to do something I've been doing and it's probably going to do the same thing I expect to see happen any other time. But you're not excited about it. Now, that doesn't mean like I'm grinning, this morning when it delivered like I wanted it to. Well, I even typed it out, right? Cakewalk and smiley face. Because it's stuff that I teach and it just keeps delivering. And I'm not questioning the efficacy of this in the future because, even if I was to triple Larry Williams' record next year, which I'm not aiming to do that, by the way, the idea of drawing more attention to all this stuff, it's not going to change anything, folks. Because the fundamental basis of which the market's book price That won't change because they're never going to let it be buying and selling pressure to control it. So forget about it. You ain't got to worry about that. They're always going to manipulate it and control it. So there's going to be a predetermined high and low. Who cares? And even if they do increase the level of manipulation, so what? They can't create a seek and destroy day every single day because nobody will ever invest. So why the fuck are you worrying about shit that ain't something to worry about? You're going to have a losing trade. You're going to get stopped out once in a while. It doesn't change anything. It doesn't change anything. But it changes everything if you expect that you're going to be able to go out here and trade with never a losing trade or make lots of money with no real drawdown. Like that's unrealistic. That's unrealistic. And it's important that you understand that, okay? All right, so now let's go over to ES. I know, like, man, alive, we're going to get into another market, Michael? This is ridiculous. I trade Forex and you're still talking about this stuff. All right, so let's go to a daily. All righty, let's scribble on over here. Relative equal lows. Sell side would be residing below that. Nice. Reach there last week. And what's resting right here? You see that? What is that? We've been talking about it all morning, right? What is that? What's that PD array called? Volume imbalance. That should be on your chart. I believe that we'll probably see S&Ps traded to between now and 8:30 on Friday. Now, what does that mean? Is that an invitation for you to trade? No, it's an invitation for you to study. It might not do it. It might not trade there. It could just fall out of bed and never go there this week or the rest of the year. I'm saying that because we have a fair value gap between this candle's low and this candle's high, but we have a volume imbalance. So your entire range shaded there should be this. That's how you should have it on your chart. Because you can't ignore a volume imbalance if it's part of, or what would be part of a fair value gap. So if there ever is a separation between two candles that would otherwise be like this would be a normal fair value gap, right? You would expect that. But I taught you that you have to use the volume imbalance in concert with that fair value gap because that's the range they're going to use. Because if you don't do that, you won't have the real consequent encroachment. You won't have the real halfway point. You won't have the real upper and lower quadrant levels. See the importance of that? So it's really important to know that just because I introduce something doesn't mean that you know it. You should go out there and risk more money. But you have to go through a process of studying it. You have to have the real rules, not just make it look like I have a chart that looks like ICTs now. It doesn't work like that. You have to know the logic behind it. Okay, and that's why I talk to you with a long-winded approach because I give a shit. I want you to learn it correctly. I don't want to just go out here and make videos for the AdSense of it. What are you going to say when I stop making videos? What the hell am I doing then? Right. I'm not delivering pizza, right? I want you to learn. I want you to learn it correctly. And that means it's going to take a lot of lecturing in detail, and some of it's going to be boring because you are not at that point of which it means anything to you yet. But when you start to try to use it and your heart's in trying to figure out how to use it correctly, you're going to listen to these lectures and then it's going to be like, wow, I can see where I was making a mistake there, or I wasn't considering that factor, and now I can see it better. And now you're going to go out and do it better now. That's the proper learning curve. But some of you just don't want to do that. You want it to be right away real quick, and it doesn't work. It doesn't work like that. So there's our daily chart. So just be mindful of that here. This right there, you see